So to give context and introduction, Bhavesh is with a firm called Equirus. They have led many IPOs over the past couple of years. The most interesting thing that I found from our conversation, we had an in-depth discussion with them a couple of weeks back. They only take mandates that when they have no other mandates on their plate. And they take everything to completion before they take the next one. And that to me is the definition of concentration. So, and in that context, they have said that Droom is one of the businesses that meets their criteria. And that's really exciting. And I think for us, having been in this business for a while, having seen the challenges, the tribulations, the changes that we've got to go through, to get that kind of validation that there's an opportunity here that seems that compelling is very exciting. And so, before I get into it, maybe Bhavesh, is there anything more you would like to give on Equirus as a background?
Thank you so much, Sandeep, for first of all having me here, and you've done most of the talking what I would have done for Equirus, but yeah, I think just to add to that, we're extremely selective about what mandates we take, and the focus is always to see how do we get deeper into the business, because the market is out there with a lot of IPOs. How do you get the focus? How do you get the attention of the fund manager onto the business, and that can come only through tech. So that's the opportunity.
Fantastic. So I'm going to actually start with Sandeep. Sandeep, it's been a journey in the last year. I think it's been a journey over the last many years of evolving the business. I think we started out, we talked about why couldn't a classifieds player get into this kind of world? And your statement back then, and I remember the way in which you said it scared everyone, that if that were the case, the Washington Post would do what Amazon does, right? And that was the view you had. And I think since then, you've understood and evolved the business further. Maybe we just take a step and start with where are we as a business today, and what is the state of the company?
Sure, Sandeep. First of all, thank you for having me. Sandeep, we took a very different approach from day one. When I started Droom, India already had classifieds, which I will call as a substitute of a Saturday newspaper ad. They do a good contribution, but dog wanted, accountant wanted, car for sale, home for sale, looking for a match for a 26-year-old boy and become an IAS officer. They do all these classifieds. And word needs that. Craig Newmark in 1994 brought that category online. Then any high involved category, like if you're traveling, you will go to TripAdvisor, whether you want to stay in Ubud or Savniak, if someone is familiar with Bali, or North Goa or South Goa, which restaurant for seafood. But when it comes to booking travel, you will go to booking.com or Agoda or Expedia or Make My Trip. So every high involved category has a vertically focused content. That is a second category which always existed. Like if you want to invest in stock market, you will go to in India, Economic Times, Money Control, in US, Yahoo Finance, Bloomberg. But when it comes to trading, you'll go to Robinhood or Schwab or E-Trade, and else, right? And then the third one was the physical category, right? Everything Amazon sell, everything Zomato sell, also always had a physical way of selling them. That's what internet did. They brought a new channel for distribution. So these online classifieds, vertically focused content, and physical dealerships always existed. So when I was starting, I did not want to just have yet another Me Too company. So I thought that, travel that time reached 35% online. Multiple other categories, like people, when Amazon launched Amazon.com, people said books is fine, CD is fine. How can I buy jeans without trying out? Every jeans has a different fitting. Shoes I need to wear. Today 14% of fashion categories online. So we made a bet that,
but in fairness, they deal with about 25% returns. So it's a challenging economic.
That's like, yes. So, and I agree, but thing is still, the category has gone a long way. So that's why I thought that, look at, when I look at, I said, taking admission, getting married, buying home, and car are the 4 largest spent by a human being. So why this one category has to give so bad experience? When you go to a physical store, forget about sunroof, moonroof, you may not even get your favorite exterior color car, right? Typically, if you go to like 90% of the cars sold in India come from an unorganized market with fragmented seller. And do you know 85% of the cars sold in India have a tempered odometer? And in India it is called buyer beware. You inherit someone else's problem. right? So this is the category. So I thought, the whole definition of innovation is what is now possible, which was previously not possible.
So Sandeep, I'm going to fast forward a bit because everyone
Sure.
knows the value proposition here. What changed over the last year?
So Sandeep, I would say, because I'm a analyst, Wall Street analyst and tech entrepreneur, so it is very difficult to take out the analyst from me. So I would say from 2010 until 2021, there was a tech rally. Right, from the financial meltdown coming out of that until 2021, there was a tech rally. If I'm a first generation entrepreneur creating a company which rely on external capital, I must follow the KPIs which are important to my investors. So the two KPIs were market share, grab market share, and over time you'll figure out a lot of other things. And second one was growth at any cost. So that's what I followed. January 2022 it changed. It was shift from market share to profit share. And second one was no longer growth at any cost is no longer a KPI. Profitable growth is a new KPI. So, and now I have a 9 years of data and learning from running this business. So, so just to give you a sense, the biggest thing change for us is, I as a marketplace can make money, which is a subset of what a seller can make highest. My money is, I'm a channel for him, so my money will always, the money I can make is subset. So I used to make 2-3% on value car segment, 4 to 5%, 3 to 4% in a mid market, and 4 to 5% on luxury. So I said, if I let go the market share, but I get out of the value segment and only focus on mid premium and luxury, I can actually, I'm solving for profit no longer on market share, right? So I did that, and then I said, I will give myself minimum reaching $500 million in GMV and 25 million in net revenue with new strategy, where I can say, we are on a right path, now we can dial up. So we achieved that, so we did that. Our annual GMV came down from 2.6 billion to like a very low number, 200 million. But today I'm happy to share that it's 625 million, right? Honestly, our first month annual run rate of net revenue was 8 million. It is 32 million now, right? But biggest thing, my take rate has gone up from 3% to 5.2%. My average order value has gone from $14,000 to $34,000, right? And the beauty is, I have actually, because all other models in India, whether online or offline, are either inventory heavy or physical heavy, so it is not pragmatic for them to enable the segments I focus on.
Bhavesh, I want to bring you into this now because you don't necessarily have the burden of the many years of the journey that Sandeep went through. You heard the story recently. You've had the chance to see many other IPOs and perhaps work on many of them in this space as well. What attracted you in the dynamics of what we're going on here?
Sure. If I may just take you through one of the slides, just shift one more. Yeah, this one. So I think you just need to shift it up. Yeah, there you go. So I think what do generally investors look for in an IPO in our view? Investors look for differentiated stories to begin with. And those stories need to be in a very large TAM. And the companies which are operating in that TAM need to solve for that, achieving that TAM in a very differentiated manner. So that's A part of the story. Second part of the story is the financials part. So there are two things which investors look for. A is the story and B is the financials. On the financials, growth is very important. Profitable growth, as Sandeep said, is very important. So this is on the P&L side, but the BS, the balance sheet side, how efficiently you are able to achieve that profitability also from a capital resources standpoint. So the metrics like ROCE, ROE, your cash flow generation, your working capital, all of that you really put together. These are the two dynamics they look at. And on top of it, the management. Who's the management here? Does he have the track record to kind of deliver what he's expecting to deliver? I think these are the things that really kind of, the markets look at. And when we kind of think about Droom here, and we juxtapose this criteria into what Droom is, I think we are really impressed with what Sandeep has been doing in his earlier life and what he has done with Droom, with his credentials, number one. Number two, the way Droom is approaching this large TAM, of course it's a very large TAM that we're talking about, in a very differentiated manner. There are so many players out there, card trade, this, that, everything. There are so many players out there. But the approach which Droom has taken is a very asset-light approach, making sure it's very online-ish, kind of approach, making sure that the customers get what they want. And then there's now a division, a change in the strategy, which basically is saying that how can I now achieve profitable growth? And we're seeing that, the green shoots out, or the early kind of, results of that change of strategy as to how the numbers are changing very nicely. And we expect that to continue. And that's
so maybe we could take a minute to talk about the IPO markets as well. Yeah. Because before, as we jump into that direction, I think everybody here has heard enough about, we're no longer FII dependent. We're now an SIP market, and the SIPs tend to cover the sins of all the FIIs leaving from time to time. But even beyond that, you talked a lot about the nature of the process changing, which I found very interesting the other day, just in terms of how allocations happen and how that process works. Maybe there's a slide?
Yeah, if you can just go 1-2 slides before. Yeah, just one more before. Yeah, so this is, I think, this is what you were talking about, which is the FII net inflow. It has been a very cyclical phenomenon. It still is. In fact, in 2024, it was a positive number. In October, that got wiped out, and we are now at almost back to square one. But the DII inflow has just been increasing on the back of SIPs and mutual fund inflow. What that has enabled is the cyclicality of the IPO has gone, and now it's a little more consistent kind of alternative for companies to raise money by way of an IPO.
Because you were saying windows no longer matter the same way.
Absolutely. We used to have a very common slide called window of opportunity for an IPO, and that used to be like a 1 year and a 3 years horizon. And you could see that there's a slide before. So if you see the slide, so maybe 2013 there was some action, in 2017 there's some action, 2021 there's some action, right? But it's been a very cyclical phenomenon, but we now think this structure of how 22, 23, 24 has happened is going to continue for a long period of time. So the cyclicality aspect of the market is gone.
85 IPOs this year.
Yeah, so what we think is also changing significantly is the DIIs, with the amount of inflow which is coming. They all want to capture the 25,000 crores or $3 billion worth of SIPs coming every month. So all the mutual funds want to capture that share. Now, how do they do this? They want to then, one approach is invest in large companies, but where the returns could be somber, but invest in younger companies or fast-growing companies where the returns could be higher. So that's how they can attract more capital. But the processes that now they're putting in to kind of deliver those investments and make those investments is now at a different level. Earlier, these were the days where some guy who knows the fund manager will say, I got an issue coming up, why don't you put money? I think those days are gone. There's a full process, analyst has to be convinced, the fund manager has to be convinced, the CIO, the IC. It's like almost like a private equity process where they do diligence, commercial diligence, channel checks, vendor checks, company checks, talk to competitors, all of that. It's a lengthy process. And finally then they invest, which I think is a very disciplined approach. I do hope that continues for a long time, because the moment they become reckless, I think it's the start of the end of the market. But this is how things are changing. So earlier it used to be DIIs would ask if FIs are putting money, we'll put money. But now it's the other way around. The FIs are saying that if DIIs are putting money,
because they're on the ground, they can meet them.
Absolutely.
So listen, I know the topic that is going to interest most people here as well is going to be around the valuation and how to think about it. I'm assuming there's a slide in here on this?
No, it's a secret.
Okay, but maybe we can talk a little bit about it. And I think both of you share a view on it. I'll leave it. Do you want to start first on how we look at this?
Yeah, so I think, without getting into numbers per se, I think the good part about capital markets is they are more forward-looking than backward-looking as compared to private equity investors. You take a deal to a private equity investor today, they'll say, what was FY24? And I'll give a X multiple on that. Right? And we as bankers will try to push him to whatever. So they'll come to 25 and they'll say, okay, let's look at September 24, right? But the markets on the other, capital markets on the other hand, they tend to look forward. So it's our capability as bankers as how well we are able to convince them that X is going to go from X to Y to Z. But once they're convinced about Z, the multiple that they give vis-a-vis a private equity investor also is much better, because the return expectations of a capital market investor is lower compared to that of a private equity investor. So we've seen some good valuation outcomes between the two. This is one way to think about it. The other is now from the company side. Think about, that's what we always advise the stakeholders for companies who are going public. Think about this as a start of a relationship that the company will have with a new set of investors altogether. These are not private equity investors, these are public market investors. They don't sit on your boards, they don't kind of veto all your actions, but at the same time they continuously watch you. They may not be actively participating, they may not be vetoing what you're doing, but they'll be voting with their feet. So how do you kind of convey the message to them? What is the relationship that you're now establishing with them over a period of time? So we really think about an IPO as a process of a long-term capital value creation journey over the next 3, 4, 5, 6, 7, or maybe.
I think as a bank, you tend to work with the companies over that journey as well.
Absolutely. As that's the other thing that we do as Equirus is we are not a transactional banker. IPO's done, take our fees, thank you very much. No, that's not the approach. We continue our journey thereafter. And in most of the cases, we continue doing a lot of transactions, helping them create value with good quality institutional investors. So I think the idea is that let's not use the IPO as a mechanic to kind of cream the market, get the best valuation out, leave something really reasonable, nice, let them make money, let them see the proof of the pudding is in the eating, let them see this for 2-3 quarters, and kind of the value creation journey happens.
So obviously for that to happen, for this next step to happen, there has to be some amount of predictability in how the business is going to evolve. So maybe you can just talk a little bit about what gives you comfort around the predictability in the business over the coming months.
So Sandeep, so earlier we were single trick pony, and that is our marketplace. Let's call it around 95 or 96% of the business, right? And 4% is our emerging opportunity. Let's say 96 and 4. Now that 96 is something we have done it for 10 years, right? These are all Gujarati saying that if the business can last for 1,000 days, it can last forever. But we have done this for 10 years, right? We know enough to be dangerous. And then our new strategy worked out well. But I also don't like, but we also have one more thing, which is a macro trend, which is working in our favor, is like, and I hear this from others also, that when it has same thing happened in China, when the country goes from $2,000 GDP to $3,000, $4,000, the premiumization increase from the t-shirt you buy to the food to the travel, the premiumization, aspirational value goes up. So do you know for 20 years in a row, the Swift Desire was the largest selling cars in India, right? For the last 3 years, it is Hyundai Creta, right? So premiumization is happening. Do you know fiscal year 23-24, Suzuki and Hyundai were down 4% and mid-premium and luxury cars were up 39%. So one is our own execution, second is a tailwind, right? And the third tailwind I would say, so one is a premiumization and second is a secular shift online. COVID helped us big time, right? I mean, COVID, like we have forgotten COVID, but it has brought a permanent behavioral shift, right from finding the job to college admission, to buying the home, to home loan, to relocation. Everything is enabled by, BCG and Snapchat just published a report about India's population and demographic. 775 million millennial and Gen Z. They don't want to buy the car the way their father and grandfather bought it. If the car is not coming online, it is not cool enough.
Bhavesh, I bring you back to the valuation question for a second, because I think one of the challenges that we face in many of our new businesses, and with all these trends happening and changes happening, is what do you comp to, and how do you get comfort around that comp?
Yeah, that's a very interesting question. The reason I think is, and the challenge becomes, it's actually a challenge and an opportunity, the way I think about it, that there's no comp out.
Great answer.
So I think this is again one of the fortes of Equirus. How do you create benchmarks when there is none? For example, we did an IPO for a company called Dream, again starting with DR and with the O in it.
D is a new tag.
So Dream is a airport service aggregator. No listed comparable in India. Forget India. No listed comparable globally. The only business which is comparable is Priority Pass for them, which is not listed. So how do you create benchmarks? So that's where the challenge is, but that's where the opportunity also is, that you really have to get into the depths of the business, draw analogies as to what is the analogy over here. If there's no comparable, is Zomato a comparator? There could be there are a lot of parallels between Droom and a Zomato or a policy bazaar for that matter. There's a huge TAM, technology, and there's a way to execute it. So can we draw parallels from there? And that's use these levers to kind of convince the investors that this is how maybe you should look at it. And in fact, sometimes not having benchmark, that gives the opportunity that the legacy is not there, but can you create an opportunity to way to think about it? So that's the approach.
I know we're running out of time. Is there any questions anyone had, or anything else you guys want to hit as a closing comment?
Sandeep, although it is Bhavesh, I'm glad Bhavesh you addressed that Bhavesh and Bhavesh answered, but I just wanted to mention that like for me, honestly, one is execution, and how do we see as a public company you run only on one premise: beat and raise, beat and raise, beat and raise. We feel confident. We feel confident that we will be able to achieve that. So, but I think that what previous question in my view, that is the biggest question. Who would you compare Droom to, right? Because I can get 1 time multiple, I can get 6 time multiple, I get 9 time multiple for the same square footage based on who you will. If you can go to just one slide, and if I'll take just maybe this one. So this is what look, I covered as an analyst, I covered internet sector. At that time, the world was changing from offline to online. So how would you now do a smell test, acid test to determine that this is an online company, not an old wine in a new bottle? So one would be what Bhavesh said, large TAM. Second is the technology center of what we do. We are not an automobile company using technology. That will be called digital transformation. We are a technology company in automobile. Right? Look at my gross margin, it is 85%. Hyundai make 3% on a car. Right? I make 85% on selling the car. Right? My gross margin is that. Right? I have an unlimited scale. I'm asset light. While maybe we sold 3 more cars since this meeting happened, but nowhere someone changed the tire, replaced the battery, or fill the oil. So my point is, so what Airbnb or Uber or Amazon is for retail and housing and ride hailing, what Zomato is for food, what Policy Bazaar is for insurance, that is what Droom is.
Fantastic. I think you're very clear on the positioning. Hopefully we'll get the rest of the market to get there as well.
I'm in a right hand, so I feel like you.
Fantastic. Great. Thank you both.